The S&P 500 is up 6% from its low just 3 to 6 weeks ago. Now, a lot of people are thinking to themselves, oh, we're back. This is wonderful. And guys, we very well could be. But spoiler alert, I do not believe that for 1 second. We have not seen the lows yet. How low we go, I have no idea. How much higher we go from here, I have no idea. But here's what I want to show you. If you've watched our channel before, you've seen me draw this. Okay, we had the massive run-up. Then we had the initial crash. I think we're somewhere over here. What this is this is the suck everybody back in. Oh, guys, good news. The bad stuff is over. We're going back up to highs. Guys, at the end of the day, what matters is valuations. Now, let me give you 3 metrics on valuations for the S&P that I think matter. First one, the stock market to GDP ratio. This is considered by many and Warren Buffett to be the single most accurate display of market value and valuation at any given time. What this does is it takes the entire stock market and divides it by total GDP. In history, it should be around 70 to 80%. We're currently at 155%. That is double. So all that's happened in this recent pullback from the beginning of the year is we've gone to levels that we last saw in the 2000 tech crash and the 1928 Great Depression. That should be pretty scary to everybody. Remember, guys, just because something's priced lower doesn't mean it's a good deal. And if you think that just a lower price means a better deal, I will gladly sell you any property I own. I will just double the price quickly, then reduce it by 25% and say, hey, I'm giving you a better deal. You're still overpaying. This is why I preach understanding value. So if you're new to this channel, I'm Paul. I'm a value investor. What that means is I don't look at what I pay. I look at what I get. I will pay whatever price in the world. I remember having this back in college when I first started looking at real estate. The real estate agent said to me, what's your price range? And I said, I don't have a price range. If it's a good deal at X, I'll buy it. If it's a bad deal at X divided by 2, I won't buy it. And they didn't understand that. My whole goal is I want to buy a good deal. I don't care how it's priced. I care about buying a good deal. Price is what you pay, value is what you get. So again, we are somewhere probably around here. We're rebounding. How high we go, I don't know. But that stock market to GDP ratio says we have half to fall. The second metric is the 10-year cyclically adjusted PE ratio. What this does is it takes the last 10 years of earnings in the S&P 500 and brings it to today using inflation. Historically, we should be around 15 to 16. Today, we're at around 30. So again, double. Okay, this also shows double the value where it should be. This is a very reliable metric that was used back in the day by Ben Graham and very popular today by Robert Shiller, the guy who wrote he does the whole housing index and everything. He wrote the book Irrational Exuberance. So that's another one that's double. The final one is the price to sales ratio. Price to sales ratio. It takes the entire stock market cap divided by the sales of the stock market, and it should be around 1. It's currently 2.2. Again, over double. So these are 3 very, very, very historically reliable metrics on stock market valuation. They all say we're double overpriced. So you might sit there and say, oh my God, Paul, are you saying we're going to fall in half? I actually do believe at some point we're going to end up at half. Now, does that mean the price falls in half? Not necessarily. But we will have a big fall from here. What it could mean is values get a little bit better while prices fall. And they'll eventually meet up. So remember, keep in mind this. 5 years ago, these same metrics that the S&P was worth around 1,300 to 1,500. Today, those same metrics say it's worth about 2,000. Okay, so fundamentals got better, prices went higher, but fundamentals got better. So it doesn't have to fall as much to get to that level. This is how markets work together. Now, the unfortunate part is the market works as a pendulum. It swings from side to side. Here's what happens over a long run. Here is the stock market's value over the long run. And here's what the price does. It's never really at value. It's either over or under. So even if I say the S&P is worth 1,800 to 2,000, even if the S&P fundamentals get better and I say, hey, it's worth 2,200 to 2,400, we will still likely see a price lower than 2,200 to 2,400. Why? Because we never, ever, except for blips, go to value. We're always either above or below. So what does this mean to you as an investor? Well, you might be sitting there saying, oh my God, I want out. Do not sell your long-term ETFs. Please don't. Don't overreact, because we never know what's going to happen. And your job in that graph, as it goes here, and the price goes like this, your job is to buy every part along the way. You'll overpay sometimes, you'll underpay, but over long periods of time, you will do exactly this. Now, let me give you another scary stat that should scare you into doing this. When banks have done their look back to see how investors actually did, and the market did 10% a year, the average investor made 2.5% a year. Why? Because they bought here, then got scared and sold here. That's why you dollar cost average, because if you just dollar cost average, you make 9.9% per year. If you don't dollar cost, you match the market, I should say. If you don't, and you let your emotions get the best of you, by the way, the emotions will get the best of you because we are still humans. And very, 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 very few people are able to really manage their emotions in investing. So if you do succumb to the emotions of it, you will lose 70% of your investment returns just by buying and selling at the wrong time. And please don't think that you're any better than everybody else. Even I adhere to my process. I force myself to keep stocks that have gone down, even if I'm scared of where the stock could go, because I want to train myself into sticking with a process. So if you stick with this process of dollar cost averaging, you will crush all your friends by 4 times. Just dollar cost average. It's so easy to do. Now, still learn, still watch our channel, still join our community, and look at our software as a way to understand investing better. And then you can make better picks on an individual basis, but always dollar cost average and low cost ETFs and index funds, because you're not going to be able to sit there and beat the market in terms of an emotional standpoint. That is the hard part. Everyone buys here and they sell here. You're not going to be any different. And I don't mean that as an criticism. I was the exact same way. Let me tell you a story. 16 years ago, before the Great Recession, 2 of my friends had just gotten married. They just started their career. They said, Paul, we want to sit down with you and talk about our savings. So they sat down, we talked about it. And I said, guys, if you do this, this, and this, you'll have plenty of money. Awesome. But I said, let me ask you one question. If stocks fell in half today, what would you do? And the wife looked at me and goes, well, we just buy more, right? I said, perfect. Exactly. Fast forward a year and a half. I get a frantic email. What are you doing? And I'm like, well, I'm buying more. How are you buying more? Didn't we discuss this? Paul, I sold everything. I can't imagine it going to zero. And I was like, oh my God, literally a year and a half ago, we talked about stocks going down 50%. And she looked at me and said, and she almost thought I was tricking her. We'd buy more, right? And here we are, a year and a half later, we weren't even down 50% yet. And she'd already sold everything. Fast forward a few years, they were all back in. They missed this part. They went from here down to here and bought back in over here. They'd missed all of this buy-in. Buy. You might sit there and say, oh, they only missed this part. No, they could have bought in all along the way. They could have been dollar cost averaging all along the way, and they would have probably hundreds of thousands of dollars more today if they had just done that. Now, does that mean you invest every single month? No, it means you pick the right time. Somebody on the show here puts the money in his Roth IRA every January 1st and buys his long-term ETF January 1. Perfect. Now, could he do every month for a year? Absolutely. But what matters is every January 1st, he does the same thing over and over. It doesn't matter what the time period is, as long as you're consistent and do it like clockwork. That is what matters. You will absolutely beat your friends if you do that by basically matching the market. That is your job, because 82% of money managers and actively managed mutual funds do not beat the market in a given year. I used to say it was 10% over a 10-year basis. I read a study recently that showed only 3% of actively managed mutual funds beat the market over a 10-year period. Warren Buffett had a competition with a hedge fund. He said, I will take the S&P 500 for 10 years, and the hedge fund was not able to beat Warren Buffett and the S&P 500. Not Warren Buffett, the S&P 500. That's the key here, guys. Consistency and process. And that's what we teach here on this channel. So again, if you like this video, 2 things. First, subscribe to the channel. And second, click our next video for value investing strategies for 2022.